Okay, let's dive right into this. If you are an investor, or honestly anyone paying even a little bit of attention to the financial markets right now, you already know that tomorrow night's Nvidia earnings report is the single most important financial event of the week. Welcome to this explainer. Today, we're putting aside all the hype. We are going to use hard data to really understand the massive forces colliding around this stock, map out exactly what the market expects, and uncover some hidden pitfalls that you absolutely need to watch out for. To understand why everyone is holding their breath, just look at this number, $280 billion. That is the staggering swing in market value that options traders are bracing for following tomorrow's report. To put that into perspective, that single-day anticipated swing is literally larger than the entire market capitalization of most major global corporations. The stakes here are absolutely sky-high, and the market is tightly wound.
But this brings us to a really fascinating paradox. You would think a company generating this much excitement would be on an uninterrupted victory lap, right? Well, Nvidia actually has a remarkably nasty habit. The stock has dropped after its last 4 earnings reports, despite posting stellar numbers. And, the jitters are already here. Heading into this report, the stock has actually fallen for 7 straight sessions.
So that leaves us with the $1,000,000, or I guess the $280 billion question. Is this upcoming report a brilliant buying opportunity, or is it a trap just waiting to spring on overly eager investors? Let's impartially break down the numbers, uncover the risks the mainstream coverage might be ignoring, and map out exactly what's happening under the hood.
Part 1. The numbers that matter. Eye-popping expectations.
Let's start with the explosive data forming the optimistic bull case. Last year, revenue sat at roughly $46 billion, but Wall Street's expectation for annualized revenue going forward, roughly $92 billion. The market expects Nvidia to practically double last year's numbers. That is just massive, eye-popping growth by absolutely any standard in the financial world.
But here is the incredible twist. With revenue doubling, you would naturally expect the stock to be historically expensive. Nvidia, however, is currently trading at just 33 times its trailing earnings. Compare that to its 5-year historical average of 63 times earnings. So in plain English, despite astronomical growth, Nvidia hasn't been this cheap relative to its own history in a very long time. It's trading at nearly half its historical multiple.
Combine that growth with that valuation, and you get an incredibly bullish consensus. The average analyst price target sits at $305. That's an implied upside of about 47% from current levels, with 28 different analysts slapping a strong buy rating on it. On paper, it looks like an absolute no-brainer. But as we all know, markets don't trade on paper, they trade on psychology. And right now, that psychology is highly nervous.
Part 2, 3 hidden risks. The vulnerabilities no one is talking about. That market nervousness isn't coming out of nowhere. Shifting over to the trap side of the equation, risk number 1 is concentration. Nvidia's phenomenal growth relies heavily on just a handful of massive tech giants. We're talking about the hyperscalers, namely Amazon, Google, and Microsoft. If even one of these behemoths pulls back their AI spending slightly, it hits Nvidia hard. The vulnerability here is whether smaller enterprise customers can step up fast enough to fill that gap. Then we have the second risk, and this one is genuinely surprising because it barely even existed a year ago. Nvidia is quietly becoming a banker. To keep the AI boom rolling, they are guaranteeing leases and actually financing AI deals for their customers. Analysts are raising a big red flag here, warning that this aggressive financing could transform into a massive $200 billion balance sheet liability by the year 2028. It is a completely new layer of financial risk. Risk number 3 brings us to supply constraints. Demand is great for sure, but fulfilling it is getting expensive. High bandwidth memory costs are up over 15%, and global energy costs are steadily rising. The math here is simple but dangerous. Rising input costs equals squeezed profit margins. This could really hurt their bottom line even if customer demand remains as strong as ever. Part 3, technical trading levels. The map for tomorrow night. So we have the fundamentals and the hidden risks.
Now let's build a concrete map for the days ahead. The battleground is very clearly drawn. The stock faces immediate upside resistance at $222. If buyers can push it above that line, the next target zone opens up between $225 and $230. However, crucial downside support sits between $216 and $218. If sellers break that floor, we could see a very quick, sharp drop toward the $200 level.
Interestingly enough, despite the massive dollar amounts at stake, the options market is currently pricing in a 5.4% move in either direction. Compare that to Nvidia's historical post-earnings average move of 7.4%. Expectations for volatility are actually somewhat muted right now. But don't let that fool you. When expectations are muted, any surprise in the data can trigger an incredibly violent reaction.
But what if the stock does drop? Well, history offers a very comforting statistic. Even if the stock drops immediately after earnings, which, remember, it has done 4 times in a row recently, the median gain exactly 1 year later is nearly 88%. It goes to show that while the short term can be an absolute roller coaster, patience with this specific company has historically paid off quite handsomely.
Part 4. The final verdict. Bulls versus bears.
We've laid out the data. Now it is time to weigh the two opposing market forces. The bull case points to that historically attractive valuation we discussed, an AI trend that remains very much intact, and a massive upcoming catalyst with the highly anticipated Vera Rubin platform launching later this year. But the bear case is equally compelling. They argue that expectations are simply too sky-high to consistently beat, that rising memory costs will cause margin compression, and that recent price drops prove institutions are deeply nervous.
Here is the most crucial takeaway. Watch the guidance, not just the headline numbers. A simple beat on past revenue might not satisfy this market. What truly matters is the future. If management raises their full-year outlook and speaks with absolute confidence about the rollout of the Vera Rubin platform, any initial dip could quickly become a buying opportunity. But if they sound cagey about profit margins or hyperscaler demand, you'd better buckle up. As we approach tomorrow night, remember that Nvidia reports after the market closes. The real, sustained move happens the next day once the market actually digests the conference call. Have a plan. Know those entry and exit levels we just mapped out. And above all, do not trade on emotion. Yes, there have been 4 straight post-earnings drops, but the long-term trend has steadfastly remained higher. You now have the structured data, the hidden risks, and the technical levels to see clearly through the noise. The $280 billion question is now in your hands. Based on the map we've laid out today, what is your prediction? Will Nvidia beat the massive expectations and soar, or will it fall into the tap once again? Keep learning, stay focused, and I'll see you in the next explainer.